Welcome to The Explainer. Today, we're unpacking the SASB physical risk metrics, and we're really giving you a masterclass on reporting weather-related catastrophes. We're going to specifically look at the insurance sector standard and how it asks organizations to meticulously lay out their financial exposure to Mother Nature. So let's just dive right into this by asking the ultimate industry question. How do insurers price the unpredictable? Because let's face it, extreme weather is causing unpredictable, catastrophic losses that your stakeholders absolutely need to understand. Investors want to know if you're flying blind or if you actually have a mathematical handle on the absolute worst-case scenarios. They want to know exactly how you price the unpredictable. Here's our instructional blueprint for today. We'll hit 1. The physical risk threat. 2. Disclosing probable maximum loss. 3. Understanding exceedance probabilities. 4. Modeled versus non-modeled catastrophes. And finally, 5. Reporting your monetary losses. We're going to walk step by step through exactly how to disclose these critical figures. All right, Section 1. The physical risk threat. Let's start with the escalating problem facing the insurance industry and the very nature of these physical risks. The SASB standard explicitly calls out these specific weather-related natural catastrophes that you've got to monitor and report on. You can't just group these into one generic bucket called bad weather in your disclosures. The standard demands granularity. Why? Well, because a prolonged drought impacts a portfolio very differently than, say, a sudden tsunami or a week-long winter freeze. By breaking these down into hurricanes, tornadoes, tsunamis, floods, droughts, extreme heat, and winter weather, you're giving investors a true multi-dimensional picture of your specific geographical and structural vulnerabilities. Moving to Section 2. Disclosing probable maximum loss. Let's look at how we translate those distinct weather threats into a standardized financial metric. Okay, so this is your foundational concept, probable maximum loss. As defined here, PML is essentially the worst-case scenario price tag for your portfolio, calculated using complex mathematical models. Think of PML as the absolute maximum check you'd have to write if disaster strikes. It's the metric that tells the market, hey, if the unthinkable happens, this is exactly how much financial damage we expect to absorb. It literally brings theoretical weather patterns down to hard, cold presentation currency. But you know, in the insurance game, you don't usually absorb all that risk entirely by yourself. You must report PML on both a gross and a net basis. This shows investors exactly how much risk you're transferring away. Gross PML is your raw exposure before any help arrives. Net PML, on the other hand, is the reality after your catastrophe reinsurance policies kick in. This comparison is absolutely crucial. If your gross PML is astronomically high but your net PML is low, it tells a really compelling story about your reliance on reinsurance markets and, honestly, whether you'd survive if those reinsurers suddenly couldn't pay up during a crisis. Section 3. Understanding exceedance probabilities. Now we need to determine the likelihood of these events to truly attach probabilities to the pain. The standard requires disclosure across 3 specific likelihood of exceedance scenarios. It starts with the 1 in 50 event, representing a 2% chance in any given year. And I really want to emphasize this point. Calling it a 1 in 50 year event does not mean it only happens once every 50 years. Actually, it simply means there is a 2% mathematical chance of this level of catastrophic loss occurring this year, next year, and literally every single year after. Next up is the 1 in 100 event. This is a more severe scenario with a 1% probability. The damages modeled here are significantly more destructive. It's the storm of the century, but statistically speaking, you have a 1 in 100 chance of facing it right now. Your stakeholders absolutely need to see the PML numbers attached to this specific threshold because it represents a massive jump in potential liability. Finally, you have to disclose for the extreme 1 in 250 scenario, which carries a 0.4% probability of exceedance. This is the massive, totally portfolio-shaking catastrophe. While a 0.4% chance seems incredibly small, when you're insuring thousands of properties or lives, the law of large numbers dictates that you must have a plan and the capital to survive this exact extreme tail risk scenario. No exceptions. And this matrix brilliantly illustrates exactly how your disclosure should look. It breaks down your gross PML by each specific peril across those 3 probability scenarios. Look at the structure here. Down the left side, you've got the 7 specific perils. Across the top, you have the 1 in 50, 1 in 100, and 1 in 250 probabilities. Your job as a reporting entity is to fill in these boxes. This grid provides absolute, standardized transparency to any investor looking at your books. It lets them compare your risk appetite directly against your competitors. It's a real game changer for transparency. Section 4, Modeled versus Non-Modeled Catastrophes. Let's see how this builds into reporting actual historical payouts, not just theoretical maximums. When reporting the claims you've actually paid out during the reporting period, you must separate your claims into these two distinct buckets. It all depends on whether you used a probabilistic mathematical model to simulate the hazard. Modeled catastrophes are the massive events, like major hurricanes, where you used sophisticated cat models to anticipate the damage. Non-modeled events are the sneaky ones, smaller, highly localized events like flash floods or severe snowstorms that you didn't run through a cat model. Separating these shows investors whether the financial hit you took was something you mathematically anticipated or something that caught your risk models completely off guard. And that brings us to Section 5, Reporting Your Monetary Losses. The final step, how to actually document the monetary hits from these events to meet the standard. Following this exact 4-step procedure ensures your disclosure aligns perfectly with the SASB metric FN IN-450A.2. First, you calculate the hard numbers, the benefits paid and claims incurred. Second, as we just talked about, you split them between modeled and non-modeled events. Third, you get really granular. You break those losses down by the specific natural peril, like drought versus tornado, and map it out by geographical segment so stakeholders know exactly where the hit occurred. Finally, step 4, you report those final totals, both net and gross of reinsurance. This right here, this is the gold standard for physical risk disclosure. Now, this quote right from the SASB topic summary perfectly captures why investors care so deeply about these numbers. Mispricing this risk destroys capital. It's really that simple. If your models are wrong, or if you just aren't charging enough premium to cover that 1-in-100-year event we talked about earlier, a single bad storm season can wipe out years of profit. Transparency here isn't just about ticking a compliance box, it's about proving the fundamental viability of your business model in a changing climate. As we wrap up this explainer, I want you to ask yourself, is your current reporting giving you the clarity needed to survive the next major catastrophe? Look closely at the data you're pulling together right now. Are your exceedance probability models robust? Do you know your true net exposure? Because let's be honest, the weather isn't waiting for your reporting to catch up. Thank you for joining me to master these physical risk metrics. Take these structured insights, apply them to your own disclosures, and I will see you in the next explainer.